So we're going to talk about the regulatory environment. Then we will also discuss the impact of the economic environment. So the economic environment. These days, everything is environment. Then the third thing we will discuss, which will be the last thing for today, will be the financial system. The financial system. So we picked the first one for the day, which is the regulatory environment. In the exam so far, what they test is that state four functions of this state. How does this institution's function affect the finance market or affect the financial management manager's decision? So those are how they ask the questions. All right. So when we talk about the regulatory environment, the first one that we are going to look at is the Bank of Ghana. The trending Bank of Ghana. All right. So we all know that this is finance we are learning. So everything finance, bank, all those things comes to play. All right. The financial system, all these things come to play. Now, when we talk about the regulatory environment, the first one that we want to look at is the Bank of Ghana. You know, the Bank of Ghana is really the lender of last resort. It is the central bank. It keeps the country's reserve. But most importantly, we learning finance management. There are two things we need to understand. They regulate the bank. They regulate the banks in Ghana. And number two, they regulate the monetary policy in Ghana. So these things, the two crucial things that we are supposed to know about them is the regulation of banks. Not only banks, financial institutions like the insurance companies too. All right. Then the fact that they are in charge of monetary policy. The monetary policy one is the most serious one because what they do with their monetary policy affects the entire economy. All right. So what are their functions? Of course, they formulate and implement monetary policies in Ghana. All right. And we all know that they are the lender of last resort. They regulate, promote, and supervise non-banking and even banking financial institutions. Okay. So they also make sure that the currency in the system is sufficient enough. So they issue and they redeem. When we say they redeem the currency, it means that, you see, when you have currency at TTI, you can take it back and they'll give you a fresh one. All right. So what you are supposed to know in this area is to learn at least 4 or 5 functions of these institutions. All right. These things are not things you should memorize. By now, you should know what Bank of Ghana do. All right. In the country, you should know. All right. So that is that. But most importantly, you see, they are a whole list. So how does their function affect finance? All right. You see, every finance manager has a financial decision to make, meaning that you need to source funds. Okay. Now, when you are going to source funds from the bank, then you have to be paying interest rate. Now, that thing that they do, the monetary regulations, the policy on the monetary regulations or the issues surrounding the monetary policy affect businesses, i.e., it affects banks, finance manager. Because when they increase the monetary policy, things go up. Like when you are going for loan for your, you know that they also regulate FX in Ghana, like foreign currency. So those two, for example, and please, before I even move on, when we say monetary policy, it is the supply of money, okay? Supply of money. Supply of money. So if they don't supply money into the system, it means money becomes scarce and money becomes very expensive. And that is what happens. That is what majorly happens. So when they increase this rate, bank will also increase theirs. When you are going for fund, you also have to pay higher interest rates. So that is the impact on you. That is what you are supposed to know. All right. So that is that. And the FX too is the same thing. If you are a company and you're a multinational company, if the Bank of Ghana doesn't have dollars, it means that you also have to be chasing dollars by buying it at higher prices. All right. So that is that. Now let's look at the SEC. The SEC, the Securities and Exchange Commission. What do they do? What is their main function? What do they do? So for them to, they regulate the security market, and they are supposed to ensure efficiency, fair transparency, security market. If later on we will learn something about the efficient market hypothesis, okay, you understand why disclosures are very, very key and why insider trading should be avoided, all those things. Now, you have to also go through and read their functions. As for this reading, I don't think there is much I can do. I mean, you have to read it and take 4 or 5B and keep them. All right, that is the most important thing. All right, so what does the SEC do? They advise the finance minister on matters relating to the securities trade in Ghana. Okay, and they maintain that there is fair dealings in the security system where they trade shares and all those things. Okay, they also register people for an IPO. So if you want to do an initial public offer, that is where you pass through. All right, so go through these things and pick 4 out of it. Now, the most important thing is the implication of what they do to the finance management we are learning. Okay, like I already said, the main issue is about IPO, initial public offer. All right, so this is it. This is it, initial public offer. So what does it mean? It means that, you see, sometimes you can source funds by not going to bank, but by what? Trading your shares. All right, putting shares in the system. So it is SEC who will be doing the approval, okay, and all those things for you, so that your shares can have that tradability. Okay, so that is that. So if you go public, it is the SEC people that will help you achieve that public status. All right, so that is that. Then the next institution that we, and please spend time to read this. I just added this thing for you. Is It's something I feel every finance person should know, how shares are traded on the stock market. All right. So you normally you have to pass through a broker. All right. Normally that's how it is done. Okay. And the broker will can either act as an agent or also have a market maker. All right. And if the broker is the one that is doing that, then the broker becomes a broker dealer. All right, so that is that. And later on, we will learn about the bid, offer, spread, and all those terminologies inside it. Okay, so please take note of that. But a situation where the trading is done on a telephone, like you just call, you do that, and the market maker strikes a bargain. That bargain, we say that bargain falls due for settlement in 10 days, and this is known as the rolling settlement system. So you do it over the phone, and the bargain is strike, the price is reached, and you have like 10 days, all right, to settle out. And that concept is what we call the rolling system. All right, so please know that. All right, then let's take note of this one too. The National Pensions Regulatory Authority. These people came to my office one time, and it was funny. It was just funny. I don't like it when people enter my office without their tag that shows where they work. So I said, but boss, anybody can walk into my office and tell me he's coming from anywhere. So until you show me your tag that says that this is your picture is on it, you work in NPRA, I can't show you my books. I'm also guy in But you see, when the foreigners are doing it, you say, oh, how the Embraer Juma. But when you come here, you are saying, yeah, that's it. So the National Pensions Regulatory Authority, in fact, the first thing I even ask them is that, why are you coming to my office? Your name says that you are National Pensions Regulatory Authority. My office is not pension. So how come you have come to my office? What are you coming to regulate? If you have any audit to do, go to SNET, go to Enterprise, go and do it there. But not me, normal company office, we are here. What are you coming to? They said, oh, they want to see if the information SNET has given them. Answer. Okay. So these people are, they actually regulate the pensions schemes, all right? Most importantly, the tier three. Okay, so what the tier three that you are paying, that one doesn't go to SNET. You choose your own insurance company. How is the company using your money? Okay, is it regulated properly? Okay, is there compliance issues? Okay, so that is what these people do. And why are we learning them? We are also learning them because they are, you see, one of the major sources of finance for the government of Ghana is pensions. These people invest their money. So please, the functions are plenty. They are plenty. You just go through and pick 4 or 5, all right, and let it stick, all right, so that you can reproduce. Okay, so then we will also look at the NIC. This one is for the insurance people. So they regulate the insurance people also. So that is that. I mean, pick 4 or 5 and learn it, all right. They are school. So when I say learn it, please learn. Because I don't know how I can actually it's self-explanatory. Okay, that is why I'm rolling over. All right, so please pick 4, 5 of each one of them and let it stick. All right, so that is that. After that, let's go to the where the main issues are. As in, we are approaching finance, we are now building up small. We are building up gradually. Now, let's look at the economic environment. We have the macroeconomic environment and we have the micro. So micro and macro. When we talk about the micro, we are looking at the individuals and households. But when we talk about the macro, we are looking at the aggregate demand and supply in the economy. All right, so we are talking about the national cake, the national income. All right, we are also talking about the level of employment. Those of you who have done economics, you know all these things. All right. So our focus here will be on the macro. All right, not really on the micro. We will be looking at the macro. All right, so the macro is our focus because the macro really affects the whole entire economy. All right, so that is that. That is that. So we look at the government and the issues surrounding the government. So how is the macro run? The macro is run on 2 main tools. We will learn them. We've already mentioned one of them, but we will go in deeper and learn the issues of macro. All right, but the objective of macroeconomics is simply to for economic growth, full employment. They are even here, so let me just show you. So the whole issue is that we want to grow the economy when it comes to the macro. Yeah, Kufuor and Bawumia Adjei is all about growing the economy. As to whether they are doing that or not, I leave it to your judgment. So how the economy will grow in terms of our real income, in terms of our productivity, in terms of what we can actually trade out as a nation and what we can get out of it. It is also the burden of macroeconomics to also help control inflation and stabilize prices. As to whether we are doing that now, I leave it to your judgment. Okay. So that is the burden. That is a burden. Number three, we talk about full employment. Full employment is that you create jobs, all right? You create jobs, but it doesn't really mean that you are creating. So I put it here. It says that full employment does not mean that everyone who wants job has one all the time. That is not what we mean. But it does mean that unemployment should be very low. Okay, unemployment should be very low, and involuntary unemployment is short term, because you see, when you go to the Western economy, they have actually worked this full employment full employment, because somebody can quit job today, the person can get a job today. But here, me, I was taught that before I quit job, I should save 3 months salary so that it's likely you can stay home as a professional. The maximum you should stay home is like 3 months. All other things being equal, that is a fearful, a fearful amount allowance. All other things being equal, 3 months time, you should land a new job. All right. So in Western economies, even the same day. So we should get to a point where involuntary employment is very, very short term. Okay, very, very short term. All right. So with this, so number one, we are talking about economic growth. Number two, we are talking about curbing inflation and stabilizing prices. We are also talking about full employment. Then we also talk about balance of payment equilibrium. I know you know balance of payment. All right. When export is equal to import, that is the equilibrium, so that we don't have issues of currency blues. We don't have currency issues, balance of payment deficit. No, the macroeconomic analysis is geared towards achieving all these goals. And of course, the last one is the redistribution of income or redistribution of wealth. Okay, so you can take the money from the Accra people and redistribute it to somewhere Takwai, which is somewhere close to the Sunyani Road. All right, so that they can also get some form of development. All right, so that is the objective of macroeconomics. All right, so those are the things. I mean, as for this theoretical nature, just spend time and go through it. But what we want to look at is these issues. These are what we want to look at: the macroeconomic impact. All right, macroeconomic impact. And here, like I said, we are going to talk about the fiscal policy, and these are the three main issues. You see, the macroeconomic is all about demand and supply. So productivity, demand, supply. But this productivity, demand, and supply is affected by three main things. You and I know that. Key one, not long ago, the impacts are, we are talking about exchange rate, which is a serious impact. Number two, we are also talking about the monetary policy, the supply of money. So monetary policy. Then we will talk about the fiscal policy. Okay, these are the macroeconomic issues. Macroeconomic issues. Guys, just a minute. All right, I nearly ended the class. So let's pick them one by one and talk about them. Let's talk about the exchange rate. We know that, you see, if you are going to talk about aggregate demand and supply, exchange rate is a key factor of everything. You know, when the exchange rate goes up,
prices also go up. Okay, so that is that. When the exchange rate is good, prices are also down. So exchange rate fundamentally determines the supply and demand. Okay, so it affects, for example, take fuel prices, for example. Ghana doesn't produce refined oil. So we will import. And if exchange rate is high, the BDCs will price the thing high. The OMCs will price it high. When you go to the filling station, you also buy it high. So that is how it is. So exchange rate affects the aggregate demand and supply. So that is the first thing you need to know. Then when we come to the monetary policy also affects, well, there are factors you need to understand it here. I've done all those things here. Okay, so please take note of that. The market we have the fixed exchange rate. Ghana, we don't do that. We don't do that. Ghana's own is based on demand and supply. It is floating. It is floating. Everybody, in fact, you can go to this forest bureau, price is different. You can go to the other one, price is different. The most importantly, you can go to black market, almost the price is different. All right, so that is the floating and the fixed one. At some point last year, Ghana wanted to adopt the fixed one. Yes, they wanted to adapt the fixed one. So everybody price it as this because the rate was going crazy, very, very crazy in Ghana. It got to like 15. All right, so that is that. And so I've done an analysis here for you. Okay, I've done analysis here for you. Okay, so you can look at it. At the lower exchange rate, domestic goods are cheaper in foreign markets. So demand for exports increases and vice versa. All right, so this is the vice versa. So try and catch the understanding out of it. All right, so that is that. Then we come to the monetary policy. The monetary policy, the key issue we want to talk about here is the interest rate. You see, they use this one to talk about the supply of currency, the supply of money in the economy, the supply of money in the economy. That is what they do. If they want to increase money in the economy, all that they need to do is to reduce the interest rate or the policy rate. Money, the economy will be liquid. But that is the thing that happened in Ghana that people are blaming they were increasing the monetary policy all the time, but backdoor they were printing currency for the government. That is serious. That was very, very serious. So it puts inflation seriously into the system. But you see, the money that they printed, it looks as if it is not spread across the country. It is limited to some people. That is the problem. That is the key problem. Kwabrane Bako to me have $6 million. I'm $5 million. Imagine. So these are the things. All right. So we need to understand how the monetary policy affects the economy in terms of finance. Like I said, if they increase the monetary policy, it makes price of money go up. All right, it makes it go up. It also reduces the money in circulation. So price of money will go up. When we say price of money will go up, it means that when you go for a loan, the interest rate is very, very huge. Okay, so that is that. That is the impact of that. So in terms of business, we talk about the availability of finance. Credit becomes very, very expensive. So the cost also increases. The cost of finance increases because there is a threat that you may not be able to pay back. All right, so it affects the cost. So the availability is affected. The cost is affected. The level of consumer demand is also affected because why? You won't have more money in the economy for spending, which in turn will also affect the aggregate demand, and it will also affect productivity because the entire year who produces, inflation becomes very huge. All right, so it affects all these things. It affects all these things. Then when we talk about tax policy or fiscal policy, we are talking about how government spends money, how he uses taxation as a tool to loosen or contract the economy, and how much government borrows. All right. So remember that public expenditure can be sourced from the tax that is raised and the borrowings that the government has done. If the government spends more into the economy, money will be in the hands of people. Disposable income will increase. All right. And that will lead to inflation anyway, because when money gets into the hands of people, they will be chasing fewer goods. So when more money is chasing fewer goods, that is where inflation happens. All right. So what should be happening is that productivity should increase to meet the shortage. All right. But if more money chases fewer goods, that is what will lead to inflation. Now, government can use this too. So spending, how does it do it? Spending. If government wants money to be in the hands of people, like I said, they do more projects. They spend money so that people get the money into their household and spend the money. Okay. If government don't want inflation to happen, it should reduce its spending. And that is what a typical example of what we are in now. Okay. They were calling on government to reduce spending. They said that the petty cash interest a day in the president's office is 700,000 Ghana cedis a day. Petty cash a day. So multiply it by a month, multiply it like week and month. Yes. So, I mean, the more you spend, the more money gets into the hands of people, which brings about more money chasing fewer goods. If the government wants to, work with deflation, it just decide not to spend much. So that is that. Similar way is taxation. If the government wants more money to be in the hands of people, all that he needs to do is to reduce tax. You see, when more money is in the hands of people, even though there is inflation, as a finance manager or as a business, your own is to actually find means of increasing your productivity so that you can get more into it. But if that thing does not happen, it then affects the economy. Inflation will occur, and we all know the hardship of inflation. All right. And taxation is the same. The government can let people have more money by reducing taxes. All right. But if he wants to collect money from the economy, all he needs to do is to increase taxes. So that is why you see things happening. It's the fiscal policy. Government borrowings. He borrows to spend. The more government borrows, the more riskier we are financially. And all of you know that not long ago, we had to do domestic debt exchange because this government had borrowed. In fact, next month, Kromusu will borrow a bill via treasury bill. Serious borrowing. All right. So the borrowing, later on then affects the economy. That's how it is. All right. So now, these are the things that I've already explained to you, so you can read and understand. All right. Injecting money into the economy and how it affects aggregate demand. All right. So that is that. Taxation to the same thing. All right. Then the government's borrowing. So that is that. That is that. All right, then we look at some government intervention. This class is meant to be a very, very short one because I want to leave you guys to go and start practicing the past question and send me the solutions. All right, so government interventions and regulations. Those of you who were, I don't know how many of you were grown and your eyes had opened to the economic system that happened, where Ghana had to, the government had to come in and regularize petroleum products and fix the price, which gave government of Ghana a huge debt. Nancy, I think they finished paying like 2 years ago. Yes, legacy debt on fuel, crude oil. They finished paying like 2 years ago. Now, the government intervention, you see, government must stand as a regulatory position to increase competition in the system among private sector. That is what it is supposed to do. But you see, apart from doing that, he has to, check that these private firms do not exploit the market. All right. So government come in as a regulatory body, all right, enforcing competitive policy. You set price, minimum price, that is regulation, all right, so that people will not exploit the market. So that is a key thing that they do, and this is it: regulation. The government interference in the free market. All right. So when he sees that people are exploiting the market, and I think that was what happened, which brought about the deregularization. And these days, too, what is happening is that good oil for good, or good for oil. That is it. Good for oil. That is another thing that is happening. Good for oil. That is another thing that is happening. And obviously people have already started telling us that there is a problem about this. All these politics, just don't want to go into it. But if you weigh the pros and cons, gold for oil, the value of our gold and the oil that we get, yes, the BDCs have decided to even go on strike already. Yes, and the first ones that we did ended up we having a loss as a nation. So, these politicians and all those things, I don't think they did much of stakeholder engagement in these things, but all is well. That is not our job here, but on your own, you can analyze those things. All right. So the government come in and do his regulations. All right. I mean, kind of set a fixed price where everybody can trade in, a minimum price or a maximum price you cannot exceed. It's still happening. Petroleum products are regulated in Ghana here. All right. So that is that. He can also do that by giving assistance. Those of you who have learned government grant and assistance, he can support you, financially, or also in the form of expert information or data. Please watch this one very well here, because everything these days is environmental. Everything these days. The environment is increasingly seen as an important issue facing managers, both public and private. Now, the problem of pollution and the environment appear to call for all international cooperation between governments. I don't know if you have heard about this term before: carbon trading. Carbon trading. Who has heard it before? Carbon trading. So you see, the World Forum, they will go for World Forum. They will say, Ghana, you can pollute the environment 20%. US, you can pollute the environment. Okay, you people are manufacturing based, so you can pollute the environment, let's say 40%. Then US will come to Ghana. Charlie, sell me 10% of your pollution. Let me pollute 50 so that you pollute 10. So then the Ghana will collect money. That is what we call carbon trading. All right. So that is that. And these days, green policy and sustainability has become an issue. And so as part of government interventions, all these things must be checked and explained. All right. So that is that. So green legislation is very, very important. We are getting there small. The last one, I think, is the externality, or the last but one is the externality. All right. What does the externality mean? What does it mean? It doesn't have any, it's just a broad meaning. Okay, it's just a broad meaning. So we are talking about the benefit which you receive. All right. Or look at this. Let me quote it this one like this for you to see. Externalities, we are talking about the costs which are not paid or received by the producer or customer of a product, but other members of the society. So what we are saying is that out of your green policy, there will be some costs to the company, but it will be a benefit to the society. That is all that we are saying. Just like a CSR, something that is a cost to the company but becomes beneficial to the entire society. That is what we mean. All right. That is what we mean. All right. Please, any question on that? Any question on that? Then the last one is the corporate governance guidance. All right. And this one, we have already talked about it last week, yesterday, corporate governance. So the Companies Act sets rules for companies to abide in terms of running the entity. So that is that. Then let's look at the last and the most important thing in this objective. Please, we will start main business next week, where we start using your calculators as practicing as a financial manager. As for these ones, they are just theory. We just go over it for you to understand. Let's look at the financial market and financial institutions. When we say a financial system, we are talking about, so the financial system a minute. The financial system is the embodiment of financial markets. Financial institutions. And the securities that are traded in there. So let me say the financial securities. Now, together, the system ensures that money flows from one person to another person. If you want to borrow money, it does aggregation for you, because if I want to come to, let's say, Christabel to ask for money, how much Christabel can give me is limited. But if I go to the bank, I can get more. So it helps to channel funds from lenders to borrowers. There are some people who want to lend their money, so they will take it to bank. Then there are some people who also wants to borrow. Then they will also go there and borrow. But it helps you to borrow in huge amounts. The financial system helps to hedge risk. So issues like forward, futures, options, you can only do these things in the financial system. The financial system creates liquidity in the system. All right. They serve as a means of payment. You can write a check to pay something. All right. You can also use a check to withdraw something. Those are what the financial market system does. All right. Now, when we look at the financial market, we can talk about capital markets. And these things are here. So let me just roll. All right. We can talk about capital market. The market, we can talk about capital market. Capital market is where stocks are sold. What is a stock? A stock is the unit of shares. And what is a share? A share is the unit of equity ownership. So one component of share is what we call a stock. All right. So that is that. Then we have money market. Money market is where we sell short-term investment. Something like treasury bill, okay, fixed deposit. All right. So all those things are money market. Then we have commodity market. Commodity market is where we sell oils, gold, and all those things. Then we have derivative market, where we hedge risk, okay, where we solve financial risk issues. Insurance market is where we redistribute risk. All right. Then the foreign exchange market is where we facilitate the trading of foreign exchange. All right. So all these things you need to, when you watch the news in the morning, almost the commodity market, currency market, and all those things. All right. So take note of that. Then we have primary market and secondary market. Primary market is the market where the thing is traded for the first time. It's fresh. Then the secondary market is when it's a second-hand, where second-hand securities are sold. You'll be out for airtime. All right. So that is that. Please take note of that. So the secondary market helps us to diversify, and these things you learn them you will be seeing them when later on when we are doing risk management. Diversification simply means don't put your eggs in one basket. So spread your portfolio. All right. So that is what it means. Then risk shifting. That is what the insurance people do a lot. So you shift the risk from you to the insurance. All right. So that in case anything happens, then they will indemnify you. But in terms of security market, it's the same thing. So if a company's loan stock are secured on an asset, which means that when the things go bad, the asset can be taken in place. All right. So that is that. Then we have hedging. We spoke about hedging the last time, taking a decision now to determine the outcome in future. We remember we said that, for example, if right now, I don't know the current exchange rate today, but let's say it's 11. And let's say in 3 months' time, you expect that the thing will hit like 15. Then you can secure, all right, fix it at 11 so that you don't get to 15 for it. All right, so that is that. That is that. So that is what you need to know. Then that is hedging. Take an action today to determine an outcome tomorrow. Arbitrage. Arbitrage is mathematics. It's like you work the thing in between to make profit. Okay, that is what you are doing. Okay, so what you do is that you buy matoshes. All right, you buy it at a very low price. Then at the same time, you sell it in a market for a higher price. Let me show you one arbitrage thing I did. I went to, in about 5 years ago, I went to GCB Bank. Their borrowing rate, their interest rate was 25%. So I went in there and I borrowed 10,000 Ghana cedis. All right. Then immediately I took the money. I went to Beige. There was a finance institution called Beige. All right. And Beige was giving 31%. So what I did was that I put this money here, 10,000. So whilst I'm paying 25%, which is how much? What was 25? What was 25%? Like 2,500. Yeah. 2,500 here. I was getting 3,100. So I have not done anything. No, I'm just playing with the finance institution. So this one gives me, and at the end of the day, I have 600. So that is arbitrage. So you play with the market. You take it low somewhere, you sell it high somewhere, like that. All right. So that is what you do. That is what you do. All right. Then we have, of course, we talk about capital market. I've already explained to you that that's where we sell the shares and all those things. All right. So know the differences between the market. It helps. All right. So it helps. Now, in the international one too, we have the euro currency. Please, euro currency does not mean euro. It means trading in any other currency apart from your own. So if Ghana, if you hear euro bond and all those things, that's the meaning. It means that it is in a currency apart from your own. All right. So it can be dollar, it can be UK pounds, it can be euro. All right. So that is what it means. So internationally, such markets do exist. Okay, so take note of that. Then we come to money market. In fact, there are so many money market instruments. You know fixed deposit. I know that one, you know. But there are other ones called, so we have the coupon bearing ones. So certificate of deposit is similar to your fixed deposit. Okay, so you go there, you take a certificate. It's like doing a treasury bill. You take a certificate and it has your fixed, so the thing is that, okay, you've deposited for 3 months and they will give you a rate. Treasury bill rate now is around, is it 18% or so? So now I know it will increase very soon now that they are saying they want money. So that is that. So you have the rate, 3 months time, how much you'll be collecting. All right. So it's a money market, a short-term liquidity instrument. All right. So that is that. It's a fixed rate, fixed. Even if the economy is going bad, it won't change. All right. So that is that. Then we have the repo, sale and repurchase. And please, as for the repo, learn how to calculate the repo. Repo, sometimes they bring it in your question. They bring some of these things small in your question. Now it's a brew and you don't know what you are doing. The repo is simple. This is A, all right, who sells to B, then later buys it from B again. So it's a sale and repurchase agreement. Maton adena ba maton. All right. So that is that. It's simultaneous. It's simultaneous. Mitoma ona masani wa agree se mesato. So look at this illustration that you see here in the repo. You see, Answer enters into a repo. He is selling the thing at the nominal value of the thing is 4 million. But in UK, Treasury bill for 3.94. 3.94. That is it. So here, the nominal value becomes kind of irrelevant because what he's actually trading the thing for is this. Then buys them back in 45 days. That's another agreement at this price. That is the price that you have. So what do you do? It's like doing a change. So what do we call it? Current minus previous over previous, like the way we do P1 minus PO all over what? PO. Multiply by here. It is the total days over the number of days of the repo. Take note of that. Total days over the number of days of the repo. So in this case, what is the current, which is 3.96 minus what? 3.94 all over 3.94, okay, multiply by 365 days all over your 45 days. That is how you calculate your repo. All right. But in the exams, be careful. They can change this 365 days and make it 360 days. So that is how you calculate repo. Anytime. In fact, these days they bring it in the exams a lot. They bring it. So know how to calculate your repo. It's P1 minus PO all over PO multiplied by the total number of days as given in the question, divided by the number of days of the repo. That's all. You are done. Then we have discount instrument. Discount instrument. We have some instruments that you can invest in. Then ubetumi akọ bank also will use it and your own discount amount. Yes, it's there like that. Maybe Jimmy Sika, me and I'm casting me save at any 3 months, but maybe and you see that they will discount it for you. So these days the EcoBank this thing is like that. Mark to market value. That is it. If you are going to withdraw your money, they will say it is mark to market value. So that is what happens. All right. That is what they do. Okay. So we have instrument like the treasury bill. I know how you know how treasury bill works. We have commercial paper and we have commercial bills. But look at, and this one too, you need to learn how to calculate commercial paper. You need to learn how to calculate commercial paper. And it's simple. Look at the illustration that I've provided for you. CP wishes to issue commercial paper for 90 days. So you have your 90 days. And with it says that at an implicit interest rate of 5%. So that one, so 1 plus R, you should have that one too there. So I'll give you a formula to use. Then it says that, note, this could be expressed at stating that the paper is issued at a discount of 5%. What does it mean? It tells you that the whole thing is 100% until we issue at a discount of 5%. Now, when you get the rate, if they quote it like this, it's the same thing as saying that the implicit rate is 5%. All right. Now, when you have it, what do? You have to just put in your amount, okay? Then multiply by, in fact, you can even decide to put the amount on top. So it's like the way we do PV. So something like this. but it's just that this is not like it's a future, but the amount is my interest, 1/1 plus R. So you have that one. All right. Then you use the number of days. You will use the number of days. So here, the same thing, 1 plus R, no, multiply by how many number of days? Here is the days over. It is a ripple. It is the turnaround. Please note that it is the turnaround. So that is that. So if you go ahead and you do, please, so can somebody do that and get me the final answer? Can somebody do that? Punch your calculator and get me the answer, because I want to check something on the figure that is there. Because the raised to the power, that raised to the power, that is, this thing is a, let me do it well for you. Let me do it well for you. So it's like A into bracket 1 plus R raised to the power n. This formula is familiar with you. It's just that the n is where you need to be careful. It's not a full year. They are doing it 90 out of 365 days. So I think I am having 9880.41. Check your side for me, 416. All right. Please check your side for me. It's 9 million. I've rounded it like to this place. So check your side for me, how much you have. If you had the same thing, let me know. So
yes, sir, it's the same thing.
It's the same thing. The same thing as this, right? Or this?
Yeah, the same thing as this. Then 988041.
Yes. So you check that, okay? So that is that. All right. Then we have derivative. As for derivatives, we will deal with derivatives in financial when we are doing risk management. All right. So that is that. Then probably the last thing we should look at is the financial institution. Please, I'm not going to waste any time here. Fancy the role of financial institutions is the same role of financial system. Okay, it's the same thing. So we can roll that. So now it's the same thing as financial system. All right. We talked about aggregation, risk reduction, and financial intermediation. Intermediation is a simple term to mean this. The banks are here. If I want money, lender, so the intermediation means that they collect the money from one person, then they are able to lend it to another person, all right? And they do that in aggregation, because if you are going to this person directly, you can't have farmer if the money is huge because of risk. Yes, so but you can go to the bank and all those things and get that money. All right. Another places is the bank. We say bank can also serve as clearing. They do clearing. We all know what clearing means. And merchant banks today, merchant bank near the omukobo busiam. Okay, the omukobo busiam. Yes, we've been using them as our syndicated bank. Then we have savings bank. You know them. We have building societies. You know them too. Yes. And please, this one, finance companies. We have finance houses. These finance houses are like what credit matiba could be income. Quick, is it quick loan or quick credit? One of them. Yeah. There are people like that. All that they do is to lend money to people. All right. So they lend money to you, then you pay with interest. All right. So we have finance houses like that. When it comes to the finance company, we have the leasing companies. So they will help you lease an asset. They will pay, and you will be paying them the rental. We have factoring company. As for factoring company, by now they have a finance person there in factoring company, a place where you go and sell your receivables. Okay, you sell your receivables. So they will buy it and go and collect the money from your customers. So that is that. And when they buy, if the receivable is say 100,000, they will buy it at 80,000 and go and collect the 100,000 from your clients. So they will get a profit of like 20,000. So take note of that. We will be looking at these people again when we get to working capital management. All right, so that is that. We have the pension funds. I know you know pensions. We have the investment trust and unit trust. Okay, so all the investment, mutual funds for one fund, they are all invest. We have the insurance company. I know you know insurance company. All right, securitization too is there where the security. I know you know security. Security is just an investment, any shares or anything. But the process of converting an illiquid asset into a marketable asset-backed instrument is what we call the securitization or securitization. So that is that. So you are it's an illiquid. So you get, let's say you have your land, which is not a liquid asset, but you can get money for this land because you have used the bank as a backup. All right, as a backup. I say for collateral bra. That is what you use it for. That is what you use it for. All right, so that is that. Then we have this intermediation. This intermediation is just the opposite of this intermediation. It means there is nothing like this, which means that people can actually relate to themselves, like barter sort of trade. All right, so that is that. Okay, so as for the others, these are things that you should be able to go through and understand. But these ones are irrelevant. Please don't waste your time on it. But you all know what IMF is about. So just read for your just normal understanding. Something about IMF. Okay, so that is that. You can also read something about the World Bank. The World Bank is called the International Bank of Reconstruction and Development. That is its name proper. All right. So when they give you a loan, they give you for a very long time, like 50 years. Okay. And these people to give loan, when they give you, like the way IMF, say IMF. So you'll be paying the money back in like 3-5 years time. Okay, so that is that. That is what they call the IMF program. All right. These places, don't waste your time on them. They are actually not in your syllabus, but I included it for normal knowledge. All right. We have Bank for International Settlement and but as for World Trade Organization, you know of them. This theory too is not in your syllabus. It's not in your syllabus. The theory of comparative advantage. It's not in your syllabus, so you don't kill yourself around that area. But we are doing trade, so I mean, read for, I mean, normal thing. Understand what trade agreements are. Free trade. You can say free trader, like NAFTA, like the AFTA. You know, it's something that is happening around our world, so you should know something around them. Common unions and common markets. Okay, read something around them. Functions of the World Health Organization. I mean, it's not anything. World trade, all right, please make it world trade. It's not anything, but read around it. Okay, so ladies and gentlemen, what you are going to do for me, ignore the common size, because common size these days, ignore the common size. But after the common size, come to these places and provide me your answers. Distinguish between fiscal policy and monetary policy. Yes, who can say something about fiscal policy? Who can say something about monetary policy? What are the differences between the two?
They are all tools of macroeconomy. But what are the difference between the two? Yes, anybody. Because you are going to write for me. You are going to answer them. Yes, somebody wants to
Okay.
try.
Let me try. All right.
Yeah.
Okay. So fiscal policy is
This is
basically
fiscal policy.
yes, please. This is way governments raise revenue through taxation to finance its expenditure in an economy. And then monetary policy is just the supply or
No,
circulation of
the fiscal policy also include the spending, not just the collection, the raising of the money. It also include the spending. Okay.
yes, please.
All right.
And then
Go ahead.
that's all.
Yeah, go ahead. Go ahead with the
Okay.
monetary.
Monetary. So monetary policy is the circulation of money in an economy,
Yeah,
probably
the
by
supply.
the Bank of Ghana.
Yeah, yeah. All right. So the use of interest rates is under monetary policy. So explain two adverse effects of contractional fiscal policy. The one I said when the government wants to take money from the hands of people so that it will reduce the money in the system. So that is what we call contractionary. But we also call the opposite is the expansionary, when he spends more money so that more money will be in the hands of people. Contractionary means that the government will take more money from people, disposable income will reduce, and what will happen? Demand will fall. If demand fall, another adverse is that productivity will fall. All right, so take note of that. So please, the rest are there. Explain the agency problem. We talked about that. Explain 3 practical steps you can manage the agency. It's also there. We talked about it last week. So all these things are past questions. You need to go through, explain the following. All right, let see when you come to the latest ones, you see what they've been asking. Financial objectives. Okay, explain the 3 core objectives of public sector institution. What Jennifer you answered, non-profit making. Explain, you see this one, anybody who sat this paper after going through this should be able to answer this with ease. All right. Is shareholder value maximization inconsistent with social responsibility? Is it inconsistent? Is it inconsistent? Social responsibility is to the society. Is it inconsistent? So discuss. I want you to send me your solutions. Please, you are solving from this date, November 2019 to date, including the paper that they wrote that is not here. So get those papers and get it for me to date, everybody. So where is 2019, Seth? November 2019. That is where your new syllabus started. So start from November 20. In fact, don't start from November 2019. As a matter of fact, start from 2019. Whether 2019 will be from May. So start from May 2019. But the others at the top 2, try and find answers to them. Okay. Like something like the over-the-counter. Over-the-counter market is where you can actually go and trade how much you want to. Okay, so like Mako Forest Bureau, into me call, me say me $5,000. You can go and say you want $4,000, but there are some markets that are standardized. The amount you can exchange is fixed. If you have below it, you can't. So that if you have above it too, you can't. They won't sell you above. It is fixed. 5,000 pen on mouton and 5,000 pen on mouton. But then we have dealer market. Those of you who know dealer, it's like an in-betweener, okay, who does the dealings. All right. And as for auction, I know you know auction. It's like a bidding. We see memo of 2000, we see memo of 2001. We see memo of 5000, we see memo of 5001. The thing is sold to the highest bidder. All right. So that is that. Yeah, the dealer is like a broker market. Okay, so that is that. But please answer for me, and please, you are right, including the 2023 papers that they've done from December 2022 to December 2023. Yeah, from May. So you are starting from May to date. And please, when you finish, kindly scan it nicely and send it to me. Please, is that understood?
Hello, sir.
Yes, ma.
When is the deadline for the
The
submission?
the deadline is next week.
Okay.
The deadline is next week. Because from next week going, we are starting serious business. We are moving to we are starting, I think what will be the time value of money? Yes, it's very troublesome. So please get ready and join with your calculators. We are now starting. These things are chill. But let's start the main deal from next week. So we will start with time value of money. Have I sent you time value of money slide already?
Yes,
Yeah,
please, you have.
All right, so we can even go through before we meet. That is where the main issue starts from. So this one's the proper. All right. So any question? If there is no question, I told you we will close early today, and this is it.
Sir, please, do we have class tomorrow, FM?
No, I told you the Saturday morning, I'll communicate to you. I'll be adding. I will tell you the Saturdays that we will be meeting.
Okay.
Say no cry. Yeah. Hey, I nearly ended the class.